All right, we're on our really short reading here in portfolio management, algorithmic trading and high frequency trading. And we're not really getting into the weeds or the details of this, just a really high level view of what is all this stuff going on. So our first learning objective, LOS A, B, and C. Actually, we'll do three at the same time because it's hard to tear apart. Define, distinguish, describe. We're going to define algorithmic trading, distinguish between execution algorithms and high frequency trading algorithms, and describe types of execution algorithms and types of high frequency trading algorithms. So let's start first of all by figuring out, well, what do we mean by algorithmic trading? And an algorithm is nothing more than a sequence of steps to perform an activity, such that you could then apply that algorithm to that problem over and over again, or to instantiations of that problem. So it's really just, call it a code of how you would do things. A formula, for example, is an algorithm. And algorithmic trading is the use of a computer to automate a trading strategy. So basically, the computer is not going to think. The computer has no intuition. It's simply going to perform a series of steps that you've already pre-programmed. When we talk about algorithms, sometimes it's hard to get your head around the idea, well, why do we call it an algorithm? Why don't we just call it a formula? Well, because it's not always just a formula. There may be decision breaks in there as well. And for those of you out there that have a computer science or computer engineering background, I think you understand what's going on. I think you have a particular understanding of a language. When we use the word instantiation, you understand what that means. For the rest of you, if you want a really a nice, interesting read, there's a book out there. It's an older book. It's about, I think, maybe 10, 12 years old now. It's called The Advent of the Algorithm by David Berlinski. It's the subtitle is The 300-Year Journey from an Idea to the Computer. And the idea of the algorithm isn't as old as mathematics, actually. It's only about, he traces it back to about 300 years ago, where the idea of an algorithm first came into being, and how that eventually morphed into, how we use it today, or the terminology today. But that's a really good book. I recommend that highly. It's not very long. It's maybe a little over 300 pages, paperback. And it's just really, really interesting. How he takes you through history and the discoveries and the different maths and how we got to where we are. I'm pushing it because I've read it like 2-3 times. I really recommend it. Okay, let's go on with algorithmic trading here. We get it. It's a computer program that runs a sequence of instructions, and off we go. So let's look at execution algorithms. What are these? Well, they break down large orders and execute them over a period of time. For a couple of reasons. Reduce the probability of detection. It helps avoid front runners. If I send a big order to a broker may then send out a message to one of the traders over on the proprietary desk saying, hey, this is about to happen. Get in front of it. So if it's a big buy order, the price is going to move. Somebody will front run me. If I put an order in the market, let's say for a buy 50,000 shares at a limit order of $20, I will forever be pennied up. Somebody will always come in front of me. Oh, well, I'll get it at 20.01 because I'll never get it at 20 until his order is filled. So everyone will penny me up. I'll have to eventually walk my order up. So if I can break down the large order and execute them over a period of time and send them to different exchanges, nobody knows I'm coming, right? Reduces market impact. One big order executed at the market will move the market. One big order as a limit order will induce other people to buy in front of me and move the market. This way here, I'm undetected. And I can get a benchmark price as opposed to having to pay all on the way up. So an example of some execution algorithms, VWAP, volume weighted average price. And here's how this works. Let's say that you got to buy 10,000 shares over the course of a day, and you break them down into 10 purchases of 1,000. So you'll buy 1,000 shares at a certain price, plus 1,000 shares at a certain price, on and on and on and on. And you'll figure out what your total numerator is. That's how much money you spent, and you divide it by the sum of all the quantity. That'll be your average price, your volume-weighted average price. The execution algorithm attempts to do better than that. So it attempts to get a better price than you would using this procedure. Implementation shortfall. And this is where the algorithm will attempt to balance the market impact of your order with market drift. So it'll look at the probability of the market moving away from you by splitting up your order and doing small trades versus, well, what would happen if you hit the market all at one time? We're not going to get into, well, how do you do that? How do you actually program the computer to do that? Well, you got to talk to the quants about that, right? And now that I say quant, there's another really good book out there, My Life as a Quant. I've read that one. That one is really, really good. And some of the models that you get to in fixed income at level 2 were developed by the guy who wrote My Life as a Quant. So if you want some extra reading to do at night to get a break from CFA, Advent of the Algorithm, My Life as a Quant, they're all really good. Actually, I know that if you've gone through the fixed income series at level 2, I have mentioned My Life as a Quant there. Market participation algos. Executes an order as a percentage of trading volume in the market. So this one over here will break up the order and attempt to do better. This one over here says, you know what we'll do? We'll exploit periods in the market where volume is high or volume is low. So when volume is higher, we can get away with placing larger blocks of our order in those periods of time. So it executes it as a percentage of the trading volume. Typically used, all of the execution algorithms typically used by buy-side firms, mutual funds, hedge funds, because they want to hide their footsteps. All right, let's look at high-frequency trading algorithms. These are profit-seeking versus cost minimization. The three we just went through, the execution algorithms, were more about minimizing cost and trying to be quiet about what you're doing. These are blatant profit-seeking algorithms that say, look, I have no reason to be in the market other than opportunity. If I find an opportunity, I'm going to take it. Exploits market data, such as order flow or news feeds. So you can have different events called a quote event, a trade event, or a news event that may force the algorithm, or the algorithm may respond to these events. A quote event, a new bid or offer at a certain quantity, especially if it has access to order flow. And here's what high-frequency trading will do. There may be a new order coming in, let's say a new offer to sell at a certain quantity that's lower than the current offer. The high-frequency trading algo will spot that order flow going in, especially if it has access to order flow. It'll spot it going in and move very fast before this new offer even hits the market and stand in front of it. So that's what it hopes to do. A trade event, an executed trade at a certain price or volume. Perhaps there's something that this trade event triggers something in the algorithm. Or a news event. Maybe there's a specific word, so that the algorithm is meant to monitor the news until it finds specific words like war, earthquake, assassination, and then respond very quickly to it. Statistical arbitrage is an example of high-frequency trading. In fact, you cannot conduct statistical arbitrage unless you can move very quickly, because the opportunities are measured in nickels, in pennies and nickels, which means you need high leverage and fast speed to take advantage of pennies and nickels. Act on deviations of correlations of instruments known to be correlated. So there's a whole bunch of different examples of that. Pairs trading. This is breaks in correlation. So there might be an example of a bond and a futures on a bond that typically trade within they trade at a very tight correlation, but maybe the correlation slips ever so briefly for a few cents, and there's profit over the transaction cost and taking advantage of that. You have to spot it and act on it very quickly. Index arb, between the components of the index and the index itself, or between the components and the sector. Breakdowns and correlations there. Basket trading, rather than looking at individual stocks, you will look at a basket of instruments instead of individual securities. And perhaps there's a correlation within that basket, or that basket is correlated to something else, and that correlation breaks down. Spread trading. Intra-market, something like February futures versus December futures. If you remember, we said we price out futures with an arbitrage argument. Well, if they get out of line, there's the argument that fixes it, right? Intermarket spread trading, hogs versus cattle. Perhaps there's a relationship between hogs versus cattle that breaks down and you want to take advantage of it. Now, I don't know so much that you really want to jump on that kind of stuff very quickly. About a year and a half ago, I noticed a big spread between hogs and cattle. Typically, there's a 50-cent spread. Typically, that if live cattle is at 115, we expect to see hogs at around 65. And it got to the point where live cattle at one point was, I believe, like a 185, and hogs were like 78 cents. That spread was huge, and it stayed for a long time. So if you didn't have to be fast to find that hung around for months. It's back down to this kind of spread now, but it was at this kind of spread. So I don't know so much. I look at this one, I think, I don't know if you really need speed on that one, but there might be some correlations between some other assets that do hold tighter than this. Inter-exchange, London gold versus New York gold. That's a very common type. When we think about spread trading in ARB, we usually think about different prices for the same asset. This is different prices for different assets. So this one here I'm a little confused on. And this is the example given in the book, by the way, hogs versus cattle. I would have liked to have seen more explanation of why you think that requires high-frequency trading, but it didn't. Okay, two more under statistical arbitrage are types of mean reversion, instruments that move too far from its average price, and delta neutral, profit from time decay or volatility as long as you can stay delta neutral. That's not an easy thing to do, and especially when markets start moving and volatility starts increasing, being delta neutral becomes harder and harder. You cannot do it with your fingers in a keyboard. You're going to need some algorithm that keeps you delta neutral. High-frequency trading relies on low latency, and we don't measure latency in seconds. You measure it in milliseconds, 100 milliseconds, 50 milliseconds. First mover advantage is critical, and latency must be considered end-to-end. Market data streaming. How fast do you get the data? How fast does your computer get the data? How fast can it analyze and make decisions? And how fast can it execute orders? Now, here's the thing that's happening with some regulation in this thing. Is let's say the exchange is over here in a particular neighborhood. To get market data streaming and to get order execution better, companies want to locate their computers as close to the exchange as possible. And then so does the next person, and then so does the next person. So there might be a facility right next to the exchange, and there's where all the computers are connected to the exchange. Well, everyone's trying to get as close to the wall as possible because that's the shortest connection. Even if you can move your computer 6 feet and you can get in front of another computer by 1 millisecond, in computer time, you win. Period. 1 millisecond wins. So there is now a regulation. I believe it's a regulation. I'm not sure if it is, but the discussion was this, that, yeah, go ahead and co-locate. But here's the rule. The cable connecting your computer to the exchange must be a minimum 100 feet. Everybody's got to be 100 feet. Which means even if you're right beside the exchange or you're in the furthest part of the warehouse, you all have 100 feet of cable to travel. So it doesn't matter where you are now. It doesn't matter where in there you are. I don't know if that actually got implemented. Maybe somebody out there that knows more than me might be able to tell me if that actually happened, because that then makes it fair. Sure, go ahead and set up in this building, but you will have no advantage over anyone else in this building, because if this is the connection and this is you, everybody is got 100 feet of cable to travel from the box. And low latency is critical, especially for multi-leg strategies. If you've ever tried to use, even just yourself, even just with your broker, if you've ever tried to put on an option strategy with multiple legs, and the broker that you're using does not have multi-leg execution. In other words, you got to put on all the legs yourself. So if you're doing a bear spread, you got to buy one and sell the other. Sometimes the market moves on you that by the time you get one in place, the other one it no longer makes sense to do. You want to put them in place at the same time, so you need a broker. And I think one of the best ones out there for this kind of thing for options trading is Thinkorswim. They have all the different strategies, so you just have to pick a strategy and they'll give you a price for the entire strategy. And they'll execute all the legs at the same time. So you need the ability to, especially for multi-leg strategies such as ARB. ARB is always multi-leg, right? Buy one, sell another. Other types of beyond just statistical arbitrage, other types of high-frequency trading, liquidity aggregation or smart order routing. Most brokers offer this. The default for almost any order that you enter now, I use Interactive Brokers, it's the default is smart order routing. And what this does is it'll send your order to the venue or the exchange that has the best price and best liquidity. So you don't have to decide. You don't always have to say, look, I'm going to take this exchange and trade on this exchange. It'll reroute it for you, depending on, and it'll balance out price and liquidity. So let's say that you have a market price, but you have very large liquidity. It might make the decision that being at a different exchange with a different price is better for you because it has much more liquidity. It will reduce the impact. So smart order routing and liquidity aggregation is another type of system or another type of application of high frequency trading. We're going to say more about liquidity aggregation later, so I'm just going to leave it there. All right, number 2, real-time pricing of instruments like bonds and options. Traditional pricing techniques just may be too slow, so that by the time the exchange updates the price, the algorithm might have figured out, well, you know what, there was a brief second in there where it wasn't correct, and it can take advantage of that. It would arb it very quickly. Trading on news, well, we've already mentioned that earlier. Genetic tuning, I thought that was an interesting term for it until I read it, and I go, well, why call it something fancy like that? Why not just call it testing, right? It's basically just a huge simulation for algorithms. And you take a whole bunch of different types of algorithms and maybe combinations or permutations of those algorithms, and you throw it into this big, huge simulation, and you let them compete. They don't know they're competing. They're just executing their algorithm. But the one that does the best, well, okay, there you go. Out in the market you go. You go out there for real. So you take a big data set from maybe 3-4 years of data from history, and you take a whole bunch of algorithms and you let them go. Who's the winner? Out in the market you go, right? Genetic tuning. I don't know that I really like the term genetic tuning, but it sounds interesting and exciting. It makes you want to read, so maybe from a marketing perspective, it's a nice thing to call it. LOSD, let's move on to there. This is describing here, it's asking us to describe market fragmentation in a bit more detail, but the section is about the evolution of algo trading. So I'm going to cover market fragmentation, but explain a few more things that sort of are some of the key drivers of the evolution of algo trading. So what is this market fragmentation business? As trading venues have increased, trading in any given instrument has been split across these venues. So if you have one exchange, all volume goes through that exchange. You've got price and you've got liquidity. But if you got to take that and spread it over 12, 13, 14, 15, 20, 30 different venues from different exchanges and ATS's alternative trading systems, the liquidity in any one may not be sufficient enough. So you have to find a way to say, well, I used to be able to send my order just to one place. Now I got to break it up and send it to all these little places. Well, you need an algorithm to do that efficiently. So if volume is split across these venues, liquidity on any one exchange is also fragmentary. All right, many asset classes have experienced fragmentation, and the reason why is because as more and more asset classes move to electronic trading, the easier it is for fragmentation to occur. Techniques such as liquidity aggregation, we already talked about that, and smart order routing help solve this particular problem or exploit this problem, whichever side you want to be on. Liquidity aggregators create a superbook that combines liquidity. So at Interactive Brokers, when I click on, I can click on Book Trader. Book Trader comes up. It gives me the best bid and the best ask and all the volume. That's an aggregated volume that I'm getting. That's not a volume on any one particular exchange. It's aggregated across everything that they have access to at that moment. If I place the order, let's say that there's 2,000 shares available at a certain offer, and I place an order for 2,000. The algorithm in behind there will then split my order to the proper exchanges to fill that liquidity, because that's what exists. I don't know what's going on. I don't know what exchanges it's going to. It's smart order routing. That's all I care about as I get executed. They've invested in that technology and behind the scenes. What else leads to market fragmentation? We've covered market fragmentation. We're looking at the evolution of algo trading. What else is a driver of that? Opportunities in new asset classes, those that are becoming fully electronic, as I mentioned up here. Opportunities in cross-asset class trading, futures versus bonds, for example. Opportunities in new geographies, new markets, and new exchanges coming online. Opportunities in cross-border trading. So all of these things, think about if you didn't have a computer to do all these things. It would be very difficult for this kind of evolution in the market to go on. So my thinking is along the lines of it's not so much that algo trading is evolving as the environment changes. The environment is evolving as algorithmic trading is evolving. There's a co-evolution going on there, because some of these things may not be possible or efficient without the ability to make it efficient. All right, LOSE, describe the use of technology in risk management and regulatory oversight. When we say the use of technology, the use of algo techniques in terms of risk management and regulatory oversight. For risk management, it's kind of a double-edged sword on this one. High-frequency trading increases trading risk. Thus, the need for high-frequency trading pre-trade risk capabilities. So if that increases risk, well, then you got to manage that risk. You need some kind of pre-trade risk capability. Well, the problem with putting this in is it's more lines of code that need to be executed. It increases latency. Remember, we have latency in 3 different places. The speed it takes us to get the information from the market, the time it takes us to analyze and interpret the data, and the time it takes to respond. Well, this increases that second stage of latency by having this in. So different types here. Real-time pre-trade risk firewall. So the algorithm continuously recalculates risk exposures on positions, monitors trades as they go to market, and determines the impact on predefined risk limits before that market goes. So they see the market, the order being created, the algorithm spits out the order. So let's say here's the firewall. The algorithm spits out the order. This algorithm catches it, holds it, analyzes the impact. If it's fine, it returns a 1 and off it goes. If it's bad, it returns a 0 and the order is canceled. So that instruction right there increases latency. If a limit would be breached, the trade is blocked. Backtesting and market simulation, no need to discuss that. We understand what those things are. How is it used in regulatory oversight? Well, if the criminals have missile launchers, the police have to have missile launchers. If the bank robbers are getting away in Ferraris, the cops have to chase them in Ferraris. So if there's bad stuff going on in HFT, and if humans are involved, there's going to be bad stuff going on somewhere. That's human nature. Then obviously the regulators need the same equipment. Real-time market surveillance and monitoring to give more rapid response to potential crisis or abuse. So the goal here is to detect anomalous market movements or market abuses while it is happening. So what are we looking for? What are they looking for? Detect insider trading. Usually a large trade by a trader who does not normally trade a specific name, followed by news that moves the price. Well, you're not going to find that with all the stocks out there. You're not going to find that by eyeballing time and volume data manually. You need something that searches for that, and you need something that doesn't just search for unusual volume in an issue, but searches for unusual volume in an issue by someone who normally doesn't even trade that one. That's a footprint. Front running, unusual or coincidental orders by prop desks, proprietary desks, prior to a large trade by its brokerage. So here's the brokerage firm. Here's a big client on this side that places an order with the brokerage firm. Here's the prop desks. And this person calls down to the prop desks and say, this thing is about to happen, and they start placing trades in front of this client, and then suddenly the client places the trade, the market moves, but the prop desk has already placed orders. You need an algorithm to find that. Painting the tape. Pecking at the offer repeatedly. All you're doing is taking out the offer, and if there's small volume on the offer, you keep taking out the offer. It gives the illusion that there's upward momentum in the market, more people come into the market, drives the price up, only to sell a large quantity at a higher price. So you're sort of just luring him into the den like a coyote does with its prey. It just sort of lures him in the den, and once the prey is in the den, they all attack. So those coyotes, they are wily. All right, let's keep going. Detect fictitious orders, entering orders with the intent of quickly canceling them. Called quote stuffing. Well, why is this a problem? If I enter an order, cancel it. Enter an order, cancel it. Well, here's the thing. If I know that algorithms out there are responding to changes in bids and offers, here's what I can do. I can distract other algos, since they must all be analyzed. All of my fictitious orders, they must all be analyzed. But the source algo, me, my source algo, I get to ignore them. So suddenly, my analysis just jumped a couple of milliseconds over yours, because I'm going to slow you down by throwing a whole bunch of crap at you that you got to analyze anyways, while I get to just run past you. Unfair advantage. Wash trading. Buy and sell the same instrument to create the illusion of volume. Typically, you wouldn't do this in the same account. You'd have one account here, you'd have one account here, and you would buy in this and you would sell in this, so that over the two, you're balanced. The problem is somebody's watching, and these accounts, since they're in your name, whoever the person watching, the regulatory oversight watching, knows that these two are the same person and watches for this type of activity. I got caught doing this purely by mistake. I had options in one account, and I didn't have options in another account, and I said, well, I don't want the options in this account anymore. They're no longer needed, but I do need them here. So I put a bid in at the middle for this one here to sell at the middle, and I made this account come and grab it in the middle. It was in the middle of the night. It was options on futures. It was a quiet market, and I figured, well, let's just do it in the middle of the spread. And it wasn't many, but compliance then sent me an email saying, you better explain yourself. You're going to have to explain yourself on this one. So I had to explain myself, and you got, a good browbeating and a finger wagging in your face not to do it again. But yeah, that's how quickly they catch you. Trader collusion. Traders cooperate to manipulate the market in their favor. No, that doesn't happen. Not in the financial industry, right? Oh, other than LIBOR. Oh, well then, other than the silver market as well. Oh, and other than the oil market, and well, other than the currency market. All of those things came to light recently. But other than in almost every market, it doesn't happen. Okay, and our last learning objective, LOSF, says describe issues and concerns related to the impact of algo trading and high-frequency trading. And a note, I've been a little negative on human nature here, and a little sarcastic about, manipulation doesn't happen, does it? Here's the thing, it does, and saying it doesn't is just sticking your head in the sand and lying. The proper question is not does it happen, but why? Why does it happen so much, or why does it seem to happen in the financial industry more than what you would expect? Aren't we all really smart, intelligent people who care about our reputations? We're all from good backgrounds. We've all got our undergrad or graduates from pretty decent schools, because if you're going to get in this industry, well, everybody wants in. You got to be from the right school. So if it's all these good, decent, upstanding people, why is there so much of this? Money. Because there's a lot of money involved. There's a lot of money. And a lesson you need to learn now in life, for some of you young folks out there who may not quite understand this now, learn this now. Money changes people. Money changes people. What would seem to be a decent, good person can be changed by just the lure of money, and they're willing to go where you might not be willing to go. And here's the thing, you might not be willing to go there from where you stand now, but if there's money on the other side in a significant amount, would you? All right, let's go. Positive impacts. Number one, minimized market impact of large trades. I don't think that that is a positive thing. I don't think that that is an advantage, and I'll explain it as soon as I'm done with all the other positives. But let's say that you got to buy a large position or sell a large position. We seem to think that it's a benefit to minimize the market impact of that. I'll explain myself in a minute. Lower cost of execution. Well, potentially lower cost of execution if your algorithm works. Improved efficiency in certain markets, closing ARB opportunities very quickly, yes. More open and competitive trading markets. Well, more competitive trading markets, most definitely. I don't know about more open. We don't know what these algorithms are doing. Improved and more efficient trading venues. Okay, I can go with that. Let me explain myself up here. What moves prices? What moves prices in any market? In a goods market, in a services market, in financial assets, what moves it? Supply and demand. Supply and demand. And when supply and demand are changing, we get price. And we get signals from price. So if we see that price is increasing, that sends a signal to the suppliers to increase production. And when we are looking at allocating capital in an economy, we rely on price signals to tell us where our capital is used most efficiently. But imagine in an economy, if you try to reduce the impact of large orders on things, if you tried to reduce that impact, you would lose the informational value of the price signal, so that you couldn't adjust your production. And you would have an inefficient allocation of resources because of that. So we rely on price signals. We want to know when supply is greater than demand, and we want to know when demand is greater than supply. We want to know those things. Minimizing market impact of large trades means, look, I got a lot of supply I'm going to put on the market, but I don't want it to look that way. Or I got a large order that I want to buy, but I don't want it to look that way. But that's the very thing that the market needs to make decisions. If there's a large amount of supply coming on the market, that means that somebody's information has changed, but the price signal won't be given to us. I don't agree with that. I don't agree with that at all. I think that we need that price signal in place. So I don't know that I want to call that a positive impact of execution algorithms, but there it is. The negatives: fear of an unfair advantage, acceleration or accentuation of market movements. And that ties in to this last point down here. So I'll expand on this a little bit more when we get to algorithms gone wild. By the way, the video is out. It's amazing if you want to see it. Algorithms Gone Wild. I think this one, it was done in Cancun. I'm not sure. Gaming the market. That's spoofing. That's where you're putting, you know that algorithms have to pay attention to your orders. So you place a whole bunch of fictitious orders and you cancel them. You're spoofing the system to tie them up. Increased risk profile. High frequency trading adds to the risk profile, remember? Algorithms Gone Wild. What does this mean? Well, listen, algorithms are made in a lab. I mean, they're not made in the real world. They're not part of nature. They haven't evolved to a certain level because of natural forces. They're made in a lab, which means you don't know if they're going to travel into the real world that well. You can test them as much in the lab as you want and simulate as much as you want, but what happens if an event happens that was unforeseen and your code doesn't respond well to it? May encounter some scenarios the code is not prepared for. Hence, you may get acceleration or accentuation of market movements. One only need think of, I think it was it May 6th, 2010, 2012? I'm forgetting the year. The flash crash. One only need think of the flash crash for a situation where the beginning of the crash wasn't blamed on high-frequency trading, but the depth and the speed of it was. All right, another negative, the potential for market denial of service style attacks, streams of orders in quick succession, only to be canceled. Well, the exchange has to continually deal with that, and other high-frequency trading algos have to continually deal with that. So if you do it enough times, anybody coming along who really wants to do something will find that it's hard to get something done. Additional load on trading venues. So if you have high frequency trading and there are algorithms that are placing orders and canceling them, or responding to every change in the bid offer, you will have excessive order repositioning. All that book has to be repositioned so every time a bid or an offer changes, some of these algorithms might then do something. So then there's a whole bunch of repositioning that has to be done in the book. Increased difficulty of policing the market, especially with dark pools. What are dark pools? Well, you can't really see what's going on in there, so it's hard for any monitoring to go on. Trading venues that do not publish liquidity. Typically, you'll have a large firm that has clients, and you have a whole bunch of buy-side clients that are trading. And the probability of them, let's say one sends an order in to buy a certain volume of a particular name, given that they're large enough and they have a bunch of clients, there might be another client that is selling. Well, inside this pool, they'll match up as much as they can first before sending the order out to market. So they'll cross-match among their own clients as much as they can. So for dark pools to be efficient, you need more and more clients going in. So very large firms that have a lot of clients, like 3,000, 4,000 desks that trade with them, will set up a dark pool, and the trades will hit there first, and if they can be cross-cleared inside there, they will. Typically only available to the clients of this particular firm. All the volume and all the liquidity is hidden in there, hence the name dark pool. So how do you police something you can't see? That wraps up this reading.